It's unfiltered opinions.
Sometimes you have ideas and you're not quite sure why.
As you secure the bag.
Sometimes you meet people and realize there's probably a reason why you stayed in touch.
Just listen.
Sometimes all the pieces just come together by themselves.
I'm Jimmy Moyaha.
And I'm Simon Brown.
Welcome to Insider Exchange.
And we move on to our deep dive. This week we are taking a look at financial advisory. Do you need a financial advisor? Is there still any merit to having a financial advisor? And what do they still offer? If you've missed any of the conversations that we had in our Market Matters, we touched on what our expectations are for the budget speech that's coming out this week, Wednesday. So catch up on that. It's under the live section on our YouTube. But if you're listening to this via the audio podcast, you would have just listened to this as well. We are going to bring in someone very opinionated for this particular deep dive. Now, again, this is something that Sai and I have always been able to leverage off of in our time in the media world and in building this podcast is the rich network of friends that we have very strong opinions about things and opinions that we like to share. So we're going to be introducing someone new that you guys might not have seen on the show before, that you might not know of, but we can assure you he is very, very intelligent. He knows exactly what he's talking about because he's a wealth manager and director at PSG. Which PSG is it?
That's R21.
R21. There we go. There's quite a few PSGs, right? So there's PSG Old Oak, PSG Wealth. This is PSG R21, all part of the same family. Neelis Brink joins us in studio. He's going to be taking us through his thoughts around financial advisory. Neelis, thanks so much for joining us. Thanks for coming through. It's absolutely lovely to have you on the show. And I think this is probably going to be one of those conversations where everybody thinks it goes one way and then it's going to go a very, very different way.
Take a sharp left turn.
There we go, right? But that's why we have it. That's why we have these unfiltered opinions. I know Sai's been his own financial advisor for his entire life. And that comes from a lot of learning, I suppose.
I had one in the very early 90s.
And then?
Yeah.
There we go. So we're going to be looking at financial advisory. We're going to be looking at the role of financial advisory and if there is a place for it. Sai, let's start with that, actually. Why did you let go of your financial advisor?
It's the story of everyone's, right? I was 24 or something and my mother said, you need a retirement annuity. And I'm like, hell yeah. Yeah, I'm a responsible 24-year-old. I will get myself a retirement annuity. So I hooked up with her advisor who worked for one of the big long-term insurers. And he sold me two things, a retirement annuity that made me approximately zero money over its life. It's one of those old school ones. Remember the ones we discovered your fees were like 60% and a lot of people made money, but it was not you.
That's it.
I had one of those. He also sold me a unit trust with a 5.4% total expense ratio, excluding performance fees. It never performed. So I never paid the performance fee. And I eventually got rid of the retirement annuity and the unit trust. Unfortunately, I didn't get rid of the retirement annuity quick enough. We didn't know. It was Rob Bisconi in the early 2000s who alerted us to the problem. And even, it was probably 2008, 2010 when there was some proper fee available. But, and with respect to the oak who was selling it, who I don't have a lot of respect for, this was the industry. He wasn't being special. He didn't single me out. But what really aggrieved me, that as a 24-year-old, here I am making a good financial responsible decision, and I just get carted under the bus.
How many years ago was that, Si?
It was 94.
1994. So in 1994, that was the condition of the space. Neelis, is there still a place for financial advisory today? Or does it look very much similar to what happened there?
I absolutely love Simon's case study because this is almost what's wrong with the industry, right? So you've never dealt with a financial advisor before.
No, not in because and let's be clear. I mean, there was no needs analysis or any of that sort of thing.
There wasn't regulation at that point.
Yeah, this was just like, you need something. How much can you afford? I think this much. Can you make it more? Sure, bang, done.
So I want to unpack this a bit. And it's not to shame anybody. I think we should very clearly understand the different roles available out there. The individual that Simon dealt with, and they still exist today,
Sure.
is called a broker.
Okay.
A middleman that sells a product.
Okay.
Right? So he does exactly what is required of him. You phoned him and said, I would like to buy a retirement annuity. And this individual took one off the shelf and sold it to you.
Yeah.
He did exactly what you asked.
Yeah.
But now we must remember, Simon at that stage, that was before you got really, really rich, right? At
Yeah,
24.
I was living in Pietermaritzburg, man. There was no money in my life.
So at that stage, Simon could afford probably the minimum premium, $250, $300 a month.
Yeah.
Right? So you are not going to get a private wealth manager managing hundreds of millions of rands to
At
take
that price
care of a 300 rand price point. So where do we go from here? The long-term insurers built a system to reward someone to take care of Simon, right?
Yeah.
With upfront commission.
The broker.
Or a life-wrapped product. Exactly. So the broker. The broker sells it, and at that stage, that's way before we regulated commissions or regulated advice.
Yeah.
He would have probably made around about 3,000 to 5,000 rand in commissions from that 300 rand policy.
Okay.
The policy was extremely restrictive. So if someone wanted to decrease the premium, penalty would be charged immediately. If someone wanted to cancel the policy at some point before he turned 78, penalty.
Yeah. Paid the penalty.
And investment decisions was something like, do you like high risk or low risk?
Yeah,
That's the two options. Tick the box.
100% right. That was it. High risk or low risk. And I'm like, yeah, I'm 24, high risk. And then annual escalation,
That's
which couldn't be CPI. It had
Yes.
to be a number.
Yeah, it had to be a number.
And the number was like 10% or something. And I once ran the numbers. Like by the time I turned 78, man, I was paying 4 times my annual salary in a monthly.
That's
because
it.
10% a year for 50 years
Is a lot of
quickly
money.
gets big.
Yeah.
But now at that stage, he would ask you, but do you not want to escalate by 10%? So you want to be poor. You don't want to retire. So
Okay.
that created a whole industry of salesmen. These are not financial advisors. These are not wealth managers.
They're selling
salesmen.
a product.
Their job is to sell as many as possible.
Yeah.
They still exist today, and they cater for a very specific market. I think there is a very good place for a broker in today's structure. I think there's a place for a wealth manager. But we must understand these are two very different people.
Before we get into... Actually, let's get into the wealth manager. I want to add a third category, but let's get into the wealth manager. What then does the wealth manager do that's distinctly different from the broker?
So there has been a lot of regulation that rolled through, but I think this should have been part since day one. So I don't want to dive too deep into regulation. I think I want to dive into what should be done from a wealth management point of view. What does a wealth manager sell? Because I saw on the debate on MoneyWeb's comments, that's where you want to be, right?
Okay.
If you're bored,
The comment
delve into
section.
MoneyWeb comment section. And I saw a debate in there where an individual said, you should be looking at what the advisor, broker, or call it whatever you want, what they drive and what do you drive. And that's a fundamental problem.
Niels, what do you drive?
That's a good question.
We'll come back to that.
So, what is the better car, right? The Porsche GT3 RS, or should you be driving a responsible 3 Series BMW?
Who am I? Am I the client or am I the broker?
So, from the broker's point of view, or the advisor, whatever you want to call it, they are not there to make you rich.
They're incentivized to sell you one product and be done with you. There's no...
No, on a wealth manager specifically.
Okay.
A wealth manager is not there to make you rich.
Okay.
Strange way to think about
Yeah,
this.
wealth
They're managing,
manager.
but they're managing.
They're managing wealth. They're
wealth
not there to
manage-
create. They're not a
they
wealth
don't create.
creator.
And that's a small part of what we do.
Okay.
Our main fight is to preserve the money you have against inflation,
Ah, okay.
right? And then the track structuring thereof, what happens upon death, what happens upon disability, to manage the wealth you have. If you do not have money, we cannot create money.
Becomes difficult to get a wealth manager to manage wealth that isn't there.
Exactly. And a good wealth manager might beat inflation by 2% rather than 3 or rather than 1 or breaking even. But a wealth manager's primary job is to keep the money you've already made. So So a wealth manager, to use the car analogy from the MoneyWeb comments, should never put you in a position to buy a Porsche. You should be buying a Porsche from your income derivative,
Okay.
right? The wealth manager bought his or her Porsche from their income derivative, not from their own investments. So people tend to come into our practice expecting us to generate money for them. And we should be protecting money against the taxman, against inflation, against bad emotional decisions. So that's what a wealth manager does. A broker simply sells a product,
Okay.
and there's a place for them. Think about a stockbroker. You phone them and ask them to buy you 1,000 shares of Capitec. It's that simple. They must simply execute. Take it off the shelf. Yes, there's some regulation. They should get it at the best price possible. They should not overcharge you. There is some regulation around it. But they move product from A to B. Then you move to a wealth manager. They fight against inflation. And you said you wanted to add a third category.
I want to look at the role of artificial intelligence in all of this, because as we've come into a more modern world where access to information has become easier, it's much easier than Simon in 1994, because now at the touch of, or at a conversation with ChatGPT or Grok or whatever it is, I can ask the questions that I should have been able to ask in 1994 that I might not have been able to get the answers from. But ChatGPT can now consolidate all of that information and say, these are the best strategies, this is how they've outperformed, this is the data, this is all of that. Does that not then replace some of the work that's done in financial advisory and now give you a better edge, because the AI has no incentive to lie?
Of course. That's a brilliant question. We discussed it at length in our partner meeting a couple of weeks ago. So AI strengthens our hand as an advisory firm, because we have got the ability to do research much quicker than we used to. I'm not of the opinion that AI can replace a wealth manager, for the simple reason there's two things that AI can't do yet. AI can't tell you which questions to ask.
Yes.
So you need almost a wealth manager background to ask the right questions for the AI to provide the information. And then secondly, AI cannot manage your emotions. I spend much more time managing my clients' emotions rather than managing the money. Managing the money is the easy part, right?
The money doesn't talk back.
You put 70% of your money in growth assets, 30% in cash and bonds. Make sure you have sufficient offshore exposure to protect yourself against a weakening rand.
Come back in time.
And stop carrying on it. Right? It's that simple. The difficult part is your client contributing enough? Your client loves moving money around, right? Because they just heard about this new shiny thing that they want to pursue. It's very difficult for a client to stay in their position if the market takes a dive.
Yes.
Think about COVID,
Yes.
right? COVID unwound the market in 2 weeks' time, 36% down locally.
Yeah.
For your client to sit still there is extremely difficult. So much so that you'll see most successful wealth managers don't manage their own money.
Because it's their own emotion that they need to entrust to
Money
someone
is
else.
emotional.
Yes, but that goes for a lot of anything to do with money. I mean, I think about, so I come from the trading background as well, and you look at CFDs, and when you're in a position and Donald Trump says something and the market moves, or data comes out and something, it's the emotion and the psychology and everything that comes with it. So wealth management is no different. It's just under different parameters, I suppose, that you're managing the decisions. So how then do you cut through the noise? How then do you identify the good from the bad in terms of financial advisory? And are there specific red flags where whatever we call this advisor, whether it's a bot, whether it's a wealth manager, whether it's a broker, how do you then say that is something to stay away from? What are those red flags to look out for?
So why should you use an advisor? Why should Simon have an advisor? It's that simple, right?
Yeah, Simon, especially someone like Simon,
The layers
does all
that
of
you
his
should
work
be
himself.
going through. very first thing is I think we should be looking at qualifications.
Yes.
It's not everything. Definitely not. I know very successful wealth advisors that barely has matric. And I know advisors that's got every degree available in finance. And they still make a lot of mistakes. Right.
Okay.
But some form of qualification helps you sift through the masses. Because remember, I don't know if your listeners know this, but you can get a code to start selling financial products. I think if you have grade 10,
Okay.
right? You can apply for a code and start selling it the next day under someone's supervision. That's
Yes.
true.
Yes.
But you can start selling it the next day.
Okay.
You don't have to have matric. You don't have to have a BCom. You don't have to have a CFP.
But I suppose this is where things like continuous professional development start to then kick in to say you might have started at 0, but you need to uplift and upskill yourself so that you don't stay at 0.
But then continuous professional development as well. I mean, how well is that really monitored?
Yeah.
Fair enough.
18
It's
points a
18
year of
points that you can
watching-
get from watching videos.
Exactly.
Which we can do with a platform such as this and create that kind of content as well. It's as you said, it's about finding the right content and the right information to be able to add. Okay, cool. So education or some base level understanding of what financial products are and what it is you are selling.
And then 2 more things.
Okay.
A track record.
Okay.
That advisor must be able to show you a track record. Not what would you have done. That's easy. What have you done?
What have you done?
Show me your performance through COVID. Show me your performance through 2017, through 2008. What strategies did you guys employ when you didn't know what's going to happen next? Right? And then thirdly, and I think this is the way to keep yourself safe, is you must deal with a firm that's got different layers of protection. The amount of layers that advice goes through at PSG before it reaches the client is what keeps you safe.
What do you mean by layers? Take us through some of those layers.
So firstly, we have to develop an advice plan. So anybody, and if I say anybody, I mean my most junior advisor that's been there for a week, can meet with you and gain information because they've got a very specific list of questions that they need to ask you. They then bring that information back to an advisory board. They don't go sit and thumbsuck it themselves. They bring it back to an advisory board because there is a correct way of doing it. That's what I love about the numbers. There's a right and a wrong answer. It's that simple, right? The advisory board would then put together the advice pack. That advice pack goes through compliance and legal. And then that pack comes back to the client, and my 1 week experienced financial advisor explains it to you.
Okay.
Right? So he or she seems brilliant. They can make no mistakes, essentially, because it's been reviewed by their seniors. And you get to deal with a junior, a senior. They won't make mistakes. And then it goes back to the implementation board. And they put the advice in place. That's the only way you're going to safeguard yourself against fees. Fees is a big issue, and we'll deep dive into that a little bit deeper in a sec. But advisors simply making mistakes. I've had senior advisors simply slip up on a tax issue or slip up on an asset allocation somewhere. And that's what these boards are for, layers. It's not going to help if you deal with a single person. What if they get sick? What if they get tired? What if they just simply don't go to work today? Right. So that's extremely important when you're dealing with a firm.
Okay, so now the foundations or the things you should be looking out for there, right? But what about the costs? Because as I experienced, these things aren't cheap. And I can imagine what comes to mind is when you have a firm that has those layers in place, those layers are an overhead for you as a business. You guys you're a business. You need to make your money. So how then do we balance Sai's need for affordable financial advice, because he doesn't have all of the money in the world to spend on advisory services because he's still trying to make money.
Sure.
And how do you manage that against getting good, decent advice?
So firstly, obviously, you get what you pay for. This
Okay.
world of cheap advice does not make any sense
Yeah.
at all.
Okay.
If you go to the doctor and the doctor says, I need to refer you to a specialist, you need to go to a cardiac specialist. Your first question shouldn't be, who's the cheapest in town? Right?
It's who's the best cardiac specialist?
Who's the best?
Okay.
And then we'll go from there. Same with when you want to hire a lawyer and he says you need an advocate to present you in court or represent you in court, rather. Who's the cheapest in town? Not a question you'd ask. Why do you want the cheapest financial advice in town?
That's
So let's
a good
get
point.
started there, right? That being said, someone wants value for money.
Mm-hmm.
And this is extremely simple in my mind. You just want what it says on the box. It's that simple, right? A Ferrari selling at 10 million rand, that's not expensive. 10 million rand's a hell of a lot of money. But for a Ferrari, it's not expensive.
Okay.
But you're not going to be very happy if you drive out of there and the fastest you can go is 60 k's an hour because they didn't put an engine in it, right?
It's not the Ferrari I bought.
You want what it does on the box.
Okay.
Why are people, especially people from that had these horrible advisory experiences in the early 90s and even today, it's because they bought something that didn't grow. Because of fees, because of mismanagement, because of misallocation.
But I also think a part of that was because of the knowledge that was out there. So you mentioned those that bought financial products in the 90s that didn't grow. I look at it and say the generation that followed that and the generations that are following on are making different decisions because of that. I'll use a personal case study. My mother's been in education for over 30 years, which means her pensions and funds and all of that are managed by the PIC. Now, some of the decisions the PIC have made over the last couple of years, even without at a base level, there's certain decisions
slightly
where
questionable.
that's it, where you say, you guys put 4.5 billion rand into who to do what of my mother's pension? So obviously that then informs how I approach financial advisory and financial conversations thereafter, because I've seen what happened in the past. I've seen it not work out. I've seen retirement annuities and funds and big companies, listed companies that have not performed. And so when we take financial advisory into 2025, I say I'd much rather get my information from an AI because that clearly is not going to be working against me, whereas I've seen financial advisory in the past has worked against my parents. How do you then not carry those trauma decisions of the past? I mean, Sai, how did you do it? How did you, aside from the fact that you had the unique advantage of getting into finance and putting yourself into finance, for those out there whose parents may have had a fund sitting somewhere, now you're having to make that decision for yourself and for your kids. You're in that space where you're saying, I now need to look at that future. How do you take ownership of it without making the mistakes that Sai made in 94?
I mean, not easy. I mean, my mother also had a policy from this chap, and when she passed in 97, there was practically nothing to it. I mean, it was, and for me, I mean, it scarred me, right? I saw this thing doing terrible, and instead of sort of digging around more and saying, well, what's the problem? It was like, well, this stuff is terrible, and I just walked away from it. And probably if I'd been more proactive sooner, there would have been a better outcome from it. But it comes to your point as well, which is that distinction between broker versus advisor. This chap, I phoned him. I said, I need a retirement annuity, and he's like, well, cool, we have one. Asked me the few questions that were relevant, and
Take one off the shelf and let's go.
Yeah.
Do you own a retirement annuity today?
I do.
That's exactly my point.
Okay.
So a lot of people, because of this trauma decision, has come to a point where they say a retirement annuity is a bad thing because it doesn't grow. A retirement annuity is a tax structure. It's not a thing. It's a tax structure, right? To my mind, retirement annuity is one of the best tax structures that we see in the market.
Okay.
if it does what it says on the box.
If it does what it says on the box. Tax structure. So tax structures are going to be an interesting conversation because I happen to know this because you and I have spoken about this, Neelis, and we'll get into this in another deep dive, is that retirement annuities are not your favorite tax structure. And even though you say it's a good structure, it's not your preferred one. But we are going to leave the conversation on that note. And I want to leave it on that note because I want to leave room for the follow-up conversations. But there are basics around financial advisory. There are things you can do to avoid putting in place or to avoid engaging with a financial advisor that you shouldn't. And I want a parting thought because this is something that I know we're going to get a good piece of intel out of, right? Our unfiltered opinion of the week that we typically do at the end of our show, we're going to put it through. We've gotten one for our Market Matters. We're going to do a 2-for-1 special this week because Neelis is in studio. We're going to get an unfiltered opinion from him, and that's going to be our unfiltered opinion of the week. Neelis, the unfiltered opinion is something you believe might not be popular to hear, might be an uncomfortable thing that people might not want to hear. And I know you're not afraid of having uncomfortable conversations. So I'm going to put it to you and ask you what your unfiltered opinion is of the week.
I don't think you should be dealing with a financial advisor that can't show you a track record.
Mm-hmm. Okay.
But I also want to add to that, I don't think you should be going to a wealth advisory firm before you can afford to.
Ooh.
There you have it, folks. Wealth advisory is not for everybody, and financial advisory isn't for everybody either. That's the deep dive. That's where we're going to leave the conversation. We're going to thank Neelis. Thanks so much for joining us in studio. Neelis Brink, Wealth Manager and Director at PSG Route 21, joining us to dive into financial advisory and everything that comes with it. And we wrap this week up with Investor Insights. We're taking a look at Asian markets. They seem to be coming back into favor with the investment community, but we're also going to update our wall and see if we're going to add some things, take some things off, move some things around. Asian markets recently have been quite the flavor of the month, right?
Last 2 weeks.
Yeah.
So they were closed for Chinese New Year.
New
Well,
Year.
not all of them, but much of it.
Yeah.
And then there was the deal because China, Apple can't use its American chat GPTs in China. So they struck a deal with Alibaba. So Alibaba's gone absolutely crazy. But if you remember back to September last year when we got the stimulus and there was this giant rush in
That
China,
collapsed.
Hong Kong,
Yeah.
that collapsed. Well, we're back at those rush levels, which also happens to be back at January 23 levels, which also happens to be March 22. So markets are suddenly looking interesting. Don't zoom out too far, man, because you're going to see.
Don't look further back than that.
Yeah.
Just the last 2 years.
Yeah.
So the China story, how much of the China story, or not even the China story, the Asia story, but we say China because that is the bulk of where the attraction is Hong Kong, mainland China, maybe a bit of the Nikkei in Tokyo, but Tokyo kind of deviates from all the other movements around the world. But how much of that is markets looking for returns because China and Asian markets and even developing markets have been undervalued? And how much of that is a hedge against what Trump is doing? So Trump puts out a tariff. China's not afraid to respond with their own tariffs. And China's proven historically every single year, including the last year, that if they're going to put money into their own local ecosystem and their own local economy, they still hit 5%. They still hit 5% growth every single time.
So some of it is about valuations, where these stocks are trading in sort of mid-teen valuations, tech stocks, JD.com, Alibaba's, Tencent, et cetera. So they're trading at really attractive valuations, particularly relative to the US tech valuations, which are massively stretched. I think we've also finally moved on from the common prosperity and all that crackdown from Xi Jinping.
Okay.
And truthfully, when he came in for his third term in October 23, so now a year and a half ago almost, he pretty much said, we've done what we wanted to do. But I think the market was perhaps a little disbelieving. And on the flip side, you had Meta and Nvidia and the others all going to the moon. So why not? You didn't have to be believing you could be making your money there. And then tensions, because the whole tariffs and everything like that. The weird thing is, well, surely you rush into the US where it's safest and you go get 10 years at 4.7 or something. But the dollar index has been weak the last little bit, and Rand's picking up, dollar index has come down last few weeks. Suddenly it's like, okay, hang on a second. And it might just come to, in the volatile, uncertain Trump world that stares ahead of us for the next 3 years, 8 months, and however long, 10 months, whatever it is. If Trump does half of what he says he's going to do, what's the impact on the US economy? And the answer is probably not good. The question is, does he do half? And truthfully, no one knows. So maybe the world is looking for other places, except that we haven't seen Europe running, but before I make such bold and brave statements.
Europe's been going through quite a bit. You're very right.
But Europe's also rallied in at the Eurostoxx 50 up at all-time highs. We saw it in, the FTSE's looking sweet. The DAX was running. I think even, France is just at all-time highs. So there does seem to be a bit of a shift out of a very expensive and perhaps slightly riskier market. And if you want other tech, China's where to go. There ain't no tech really your tech in Europe is what? SAP.
Well, to be fair, right, South African markets are at all-time highs.
Like almost everything.
Everything is at all-time highs. And this is typically what we see going into Jan, Feb, March anyway. And then we see a bit of a pullback going into April. But the important thing around when we look at, and I'm looking at our wall, right? We're going to see what we update, what we add, and all of that. But I'm looking at the wall, and we have the likes of BlackRock, the S&P, NVIDIA on there. But we also have JD.com, Tencent, BYD, ByteDance. We've been liking Asian stocks because we've felt that they're undervalued. And to look at them now and still say, do we like them even more is, I suppose, the next question is now to say, we've come through a time where they were the unloved child, the black sheep of the family, because of what was happening in China and everything. But time and time again, we've just seen markets come out 3% on the Hang Seng, boosting our own local markets. Last week, what was the share price? Naspers did all-time highs, 52-week highs at $4,600, 4,600 rand a share. So there's clearly some, and that's off of the back of obviously positivity around Tencent and all of that. But Asian markets are coming back into favor, and does that then mean there's some Asian stocks we might want to add to our wall that we want to look at?
Yeah, so I'm just not the expert beyond the few big tech names.
Yeah.
I just don't know what they are. So typically I go with ETFs. Offshore it's CQQQ, which is the China tech. You can get on the Hong Kong, you can get ETFs on the Hong Kong exchange. You can get A-share China. You got two, a Signia and a Satrix locally listed on the JSE. I've never done it because I get, in all this time that China's been doing poorly, Lex, I suppose we could say, you've got your Tencent in your process, Richemont, commodities. There's a lot on the JSE. I once ran the numbers and it was, close to 50% of JSE stocks, and it's because Richemont is so big, Naspers process, throw the commodity guys in there, are dependent on China. So
the Richemont thing was quite interesting because now we are seeing luxury is coming back into favor. It's Richemont, it's the Kering Group, it's LVMH.
It's all of them.
Luxury is actually starting to run again, and that was I think that was more of a testament to how resilient Chinese demand can be. We saw Chinese demand softening and we were all concerned, oh no, this is the end for luxury. They're going to have a terrible year. And then out of nowhere, Richemont kicks us off with, 15% revenue gains. It was a mad number that then said to the market, no, it's not that bad.
Here is a fun fact. So China just had vehicle sales year on year earlier this morning. And previously it had been 10.5. It was down 0.6%. The Chinese consumer is not yet booming, is certainly my sense. And I think vehicle sales help us understand that to a degree. That would have been January vehicle sales, so it wasn't even New Year or anything like that. And maybe there's some nuances we're unaware of. But China's not out of the woods, But let's also be clear, it's not like they are a
They're not
basket
struggling.
case. Yeah, they're not a basket case.
They're not struggling
5%
along.
GDP. I mean, yeah.
They're not struggling along. They're still, I mean, China and India have the highest GDP growth rates of Asian countries. And I think, if I'm not mistaken, China is besting India on that at the moment. They are achieving slightly higher growth rates than India. I'll just quickly check the numbers for you. 2023 numbers for GDP in, well, 2023, not 2024. That was India. That was quite a big number, 7.6%. China at the same time would have been 5.2%. So 2023 year, India was stronger, but I think the 2024 stats might be swinging a little better.
India is expected to grow 6.4%.
Okay, that's still a little bit better than China there. Yeah. So either way, we're getting. So then, do we then look at that? Do we then look at the Nifty 50, which is the Indian index? It's not something I have made up. The Nifty is India's version of the
top
AllZ
40.
or the top 40.
Or the FTSE or,
Yeah. So effectively, do we then start to be more optimistic about Asian markets? And like you said, without understanding them too much, maybe go for indices, go for ETFs.
Yeah, I mean, yes. I mean, in India, yes, I do like the Indian market. I don't know the NDA. They've got a weird code for it. There we go. There's the Satrix one. It's a very weird market. Although it's done moderately well in its period of being alive, from 55 to 79, hit a high of 95. It's come under a bit of pressure. That's the ZAR one, so it's Rand based.
Yeah, so I'm looking at the Nifty 50 is down about 3.5% year to date. So,
but I mean, again, it comes back to the point is, huge economy, good growth happening, good modernization happening across India, and it does. If we throw them and China into emerging market, and we can debate whether they should be. And they're top of the pile by a long way, just because of their size.
There we are.
And India's a much more, say what you will about Modi, it's not a command control economy.
Well, he did meet with Elon Musk. He did meet with Donald Trump recently. He met with the presidents of the United States. The Asian story is a growth story, and that will filter through to markets like South Africa. I want to update the wall in light of that. I want to look at locally, there's big moves that we want to be looking at around Amplats. I want to see where we have Amplats on our wall at the moment. We've got PGMs on the wall. We are liking PGMs, but the Amplats conversation is a distinctly different conversation now, because that unbundling, we have a bit more color around what's happening in June.
Yeah, so they will be listing, and Anglo-American, it's got some 60-odd%, will retain 19.9%. The rest will go to shareholders. They've got to go to London first, because there are London shareholders as well as Joburg shareholders, because Anglo-American is listed in both. The results were a bit of a horror show. No surprise there. PGM prices, we know what that story is. Interestingly, they had 13.7 billion in cash, and they've given it all away as dividend, as a parting gift to Anglo-American.
Yeah, well,
as a special dividend.
I suppose parting gifts, recouping some money, whatever you want to call it.
Yeah. So they're calling it a demerger. So 59 Rand special dividend per share.
That's a very handsome dividend right there. That's what you call a special dividend. 59 Rand a share. Wow. So there's a lot that's happening there. Do we now prefer to then look at Amplats on its own? Do we now then look at Anglo-American? How do we now look at the PGM space?
So I still worry about Anglo Platinum, if only because your concern is that there are a lot of people who are going to receive a lot of Anglo Platinum shares around June time and might not want to hold those shares.
Fair.
Yeah, they're going to say, I don't want PGMs. I'm holding Anglo because I like the copper, because I like the iron ore. Maybe because I like diamonds. Nah, that person.
De Beers.
But there are a lot of folks, and we see this from unbundlings, where you suddenly get shares and you're like, do I really want it? I think there's going to be a lot of folks who say no to the Anglo Platinum. So I think we will see more weakness probably through to the end of the year in Anglo Platinum.
The 59 Rand special dividend. You asked the rationale behind that. And as you're saying what you're saying, I'm wondering, are we not propping up the Anglo-American price for another BHP bid?
So they Second part of the question is, do we like Anglo-American? Yeah.
Okay.
Yeah. Because so BHP wanted two things to happen. One was get rid of Anglo-American. Done. They want Kumba Iron Ore gone as well. I can't remember.
They really just said keep copper. We don't care what you do with anything else. Just make sure you don't sell the copper
De Beers,
assets.
I don't know who they're going to sell De Beers to. I think they might just birthday gift it to Botswana government. Like happy, how old's Botswana? I don't know. I don't know. What's the Diamond Jubilee?
That's gonna be an interesting conversation. Or do you then take De Beers private? Do you then delist De Beers and give it back to the Oppenheimer family, I suppose, is another option?
Well, Oppenheimer's...
I don't know.
See, I mean, does Richmond take it?
Does Richmond take it? Because you've got a place for it. So it comes back to that thing that we said about Chinese companies coming in and buying South African mining houses or whatever, when they, platinum companies in particular, when they're looking for that resource. Cartier could have very good use for their own diamond supply. But that's another conversation with the lab-grown diamond kind of craze that we're going through at the moment. So do we then see that? Does True Luxury then say we only use natural diamonds as opposed to lab-grown diamonds? And that's a narrative that you can spin out, and that's a consulting fee we'll consult on one of these days. But that's another conversation we'll have, possibly. We might even look into lab-grown versus natural diamonds. That's not for us for today. We are liking Anglo-American. We are going to put it on the wall from an international perspective as well, because of what's happening there. Are we still kind of feeling the same about some of the other stocks? So Richmond and the likes that we've had, we're still very happy with those. I'm wondering how we're feeling about someone like a Telkom that's now back above 30 Rand a share. We initially had a bit of we were neutral about it. Last week, when you were out, Mushima was on the show and she really liked telcos. Along those telcos, she said she liked MTN, she liked Blue Label, she liked Telkom, she liked Vodacom the least. We have Telkom at the moment under our neutral space, and I see they've just gone back up to 30 Rand, I think it's 32 Rand a share. 35 Rand a share, sorry, the 32 Rand was the recent lows. They'd come off 38 Rand a share. Do we like them around this level because they're saying that they're a better business, they're doing well?
So, I mean, I don't like telcos, but Telkom is also a turnaround, and that turnaround seems to be happening.
It's a good story. Yeah. It's a good story that's being told. Okay, maybe we might move Telkom out from where it's currently sitting. We'll see how we adjust that. Do we have anything new we want to add to the wall before we go?
No, I wanted to add a China, but we were so way ahead of ourselves. We already had China.
We already had China. I mean, we've got Tencent, Alibaba, JD.com, BYD, ByteDance, the owners of TikTok. They're all in the same kind of we really like them space alongside the likes of Nvidia and BlackRock. So we don't like them any less than those guys. And those are the big tech plays anyway, right? So maybe we find an ETF that we can throw on there as one that might be doing really well somewhere, or a semiconductor ETF of sorts. Speaking of semiconductor size, Taiwan Semiconductor Manufacturers, TSM. Right. TSM is...
So the China Tech ETF is CQQQ as opposed to just QQQ.
Yes.
So also from Investco, etc., and also looking a little interesting on the charts.
It's been moving quite a bit. Hey, it's bounced off of that 30 points level. It's at 47
had
points.
That September jump, as did everybody else.
Yeah.
Yeah, but it's just I haven't dug very deep into it, but it does just look interesting.
I'm looking at Taiwan Semiconductors at the moment, and the chart looks quite interesting. Look at that.
Yeah.
Look at that. Right. It is kind of a bottom left, top right kind of vibe. It keeps dipping down every now and then to just give people really good, I suppose it's liquidity sweeps here and there. But this could possibly make our list. This could possibly get on. Although as I say that, I want to perhaps do a bit more research around this, and perhaps we look into some other strong ETFs that we might like to add onto the list. But we are bullish over the sector. We have got a couple of ones on our preferred wall already. We'll continue to update them. Please send us through some of your thoughts around the wall that we have, around what you think should make our wall. We'd love to get your opinions around that. We're going to update it. We're going to see how it shapes up. I think it's an interesting time to look at this wall in the first quarter of the new year with all the changes that are currently happening. That's why we're not really in a rush to make some major announcements or significant adjustments to the wall. There's so much that's going on. There's so much that's constantly moving around. We don't want to be liking something one week and then not liking it the next week. So we're taking our time with this. We've got the whole year, obviously, to go through and adjust or make some adjustments to the wall. But the adjustments that we have discussed, we are going to make to the wall, and we're going to see how that goes. And we're going to leave the conversation there. We're going to come back to it next week. We're going to come back after the budget speech, and we're going to see what the South African market shapes up to look like. Maybe there's a bit more optimism around that. Maybe the 27 billion rand that we get to bail out some SOEs and some other stuff goes to actually doing something else other than bailing out SOEs. But this is all up in the air, and this is all stuff we're going to have to come back to next week. We've given you 2 unfiltered opinions of the week. Until next time, investing isn't hard. Just try it.